Welcome to the Solemn Yugioh channel, where we discuss everything collecting and investing in Yu-Gi-Oh! And sometimes just the markets at large. Today, we are talking to Sean, the owner of Reserved Investments. Thank you so much for being on.
Thank you for having me. I appreciate it.
Awesome. So for the people at home who aren't maybe aware of your channel yet, who are you? What do you do? What are your goals in all of this?
Yes, my name is Sean Cermak. I run a YouTube channel called Reserved Investments. I have been basically involved in the antiques and collectibles trade in some form since the age of 12. That's when I started out. I had many mentors that taught me the ropes, that taught me business, economics, and finance of not only the antiques and collectibles trade, but also the economy at large. So I have a lot of experience in these markets. I am a consultant now in the antiques and collectibles trade. Again, you can reach me at reservedinvestments@gmail.com. You can also check out my own channel on YouTube. I currently write for Antiques and Auction News. My articles appear every 2 weeks in that particular publication, where I give my take on everything about antiques and collectibles, and also where the marketplaces in general are going. I write on a plethora of topics, everything from collectibles, antiquities, pieces of high-end art, and that of traditional antiques. So I am very knowledgeable in these markets. I am also educated in the subject of business, economics, and finance. It is a passion of mine. So pretty much what I do is I look at all these markets from the perspective of somebody who is looking to either speculate or invest in these markets over the short term or over the long term. It's just how I analyze all this.
Awesome. Yeah, and your channel is amazing. I've been watching it for quite a while. I've also name dropped it a few times in videos, so I hope that helps, but I'm sure your channel will keep on doing great, even though sometimes it can be contrarian and some people might be very afraid of that. So I definitely don't want this call to be about me, but just for people who either find this video through you in some way, maybe recommendations or something like that, just to really quickly give a big scoop into my background. I'm 24 years old, which means I'm young, so I always want people to know that. I own a software company, so it's not like I'm saying, oh, we're going to be so completely rich from this stuff. Like, my software company is my income. My biggest investment position is in equities. I'm all for the actual proper markets, and then the rest is play money, but it's also just stuff I love. So it's not like I think, oh, I'm going to put my money into these cards that I don't care about and then become a rich billionaire or anything like that. So I always try to be very clear about that, push that a lot. But so right now, to push it into the actual topic, I want to say, of this talk, we often talk on this channel, and yours even more so, about the potential of bubbles in the collectible space and maybe the antique space. So are there currently, in your opinion, specific sections of the market that are in incredible bubble-like territory? I say yes, but I would love to hear your take on the specific ones potentially.
Absolutely. And what most people don't realize about speculative bubbles and speculative euphorias, they can last decades, if not longer. So there's a lot of people that will look at my channel and they'll go, well, you came on the scene in 2019 and you were talking about great at video games, how these prices aren't sustainable. Well, here we are in 2021 and these prices are still going strong. Therefore, you were wrong. And I have to pull back and say, I don't think you understand. I look at these markets in terms of decades, not in terms of months, not in terms of years. Yeah, if you want to come in these markets and you're a speculator or you're a market manipulator, you can do quite well over the short term. And the short term, in my opinion, is any investment time frame that is under 5 years. And that's what a lot of these people, I don't think, realize. These markets are very risky. A lot of them are high risk. So to answer your question, yes, I'm seeing speculative euphorias in Pokemon, Magic the Gathering, even great at vintage video games right now. All these markets are on fire. And over the long term, compared to equities or other traditional assets, I don't think 90% of the people that are investing in these markets understand that they would be better off just putting their money in a S&P 500 index fund, a total stock market index fund, or paying off your house, getting a primary residence, and then getting into real estate renting, if that's what you want to do.
Yeah, absolutely.
Collectible markets are best preserved for people who are either on their way to becoming financially established. They already have their proverbial, I'm going to say it, crap together. I didn't want to use the S word here.
Oh, we use it here, but feel free to.
Well, I just didn't want to. And they just want to diversify like 10 to 20% of their portfolio that is not invested in equities, traditional assets, gold, real estate. That's what the collectibles market works best for. But to go back to your original point, yeah, there's a lot of markets that are in speculative highs. And it's going to be very interesting how this pans out over the next 5, 10, 15, 20 years going forward. Because what we are seeing is most markets in pop culture, and I know we're going to get to this further in the discussion, but most markets in pop culture, they run on 20 to 40-year intervals. So if you go back to the 80s and 90s, when I was learning the antiques and collectibles trade, what was popular back then is not necessarily the same thing that was popular today. And there's people that want to argue with me. Well, look at comic books. Comic books had several catalysts that occurred in that market that took them to where they are today. The first was the advent of third-party grading. The second was the advent of the Marvel Universe, Disney buying Marvel and handling that to the point where every other week there's a new movie almost coming into the box office. It's keeping that in the public consciousness. I have a saying on my channel that I'm sure you've heard me say before: a collector is born, they are not made.
Yes.
Everybody running out to see the new whatever comic book movie is #1 at the box office, they're not going to go to eBay or Heritage Auctions or any of these other high-end auction platforms and pay $1,000 or $5,000 for a comic book.
Yeah, absolutely.
Markets don't work that way. And that's where my channel comes into play, because there's so much confusion in a lot of these markets where there's a lot of market manipulators, hype-driven content creators that are saying, you know what, if I do this video where I tell people these are the 5 comic books that you should invest in, or the 5 Pokemon cards that you should invest in, what's going to happen is people that share that same mindset, they're going to be drawn to that content. They're going to go, well, look, I can put my money in comic books or Pokemon cards. And all is what it does is it causes that particular YouTube video to get like 3,000 views. And that person makes a substantial amount of money just off the YouTube ad revenue. So it serves both purposes. And if that person who's creating that video is also speculating in that market, he's also going to make money, because chances are he owns the 5 comic books that he's telling you to invest in.
Yes, absolutely. And I do want to say, you can say the same thing about Yu-Gi-Oh, by the way. So it's not like you have to dance around that subject. Like, I assume, and I've been talking about it on the channel, that certain sections, and probably most sections, honestly, like I've always said, like 99% of cards will probably do awfully forever. But it's entirely possible that Yu-Gi-Oh as a whole will also, see its bearish market. I think that's due, especially when stuff reopens, which means there will be just less people stuck inside. So feel free to, if you say Pokemon or MTG, you can say Yu-Gi-Oh as well. That's all fine. So since we're then talking about stuff like, Marvel comic books or Pokemon cards, do you feel like, despite that bubble-like behavior, will there be, in your opinion, certain items, if these markets get closer to established, but not necessarily established, that will do well? Or do you feel like it's going to be the Beanie Baby scenario that sometimes people like to say, where, sure, there's the 1% of items that are still worth a lot, but it's not like they went up anymore? Like, once the Beanie Baby bubble popped, 99% went to not 0, but very, very low. And the 1% somewhat held, but it's not like it grew anymore because the euphoria was gone. Do you see that that's going to happen in Pokemon? Or do you assume that certain items will keep performing beyond the euphoria?
I don't think these markets are comparable to what happened in Beanie Babies. Beanie Babies came on the scene. They had no relevance. There was no pop culture relevance. People made them what they were. And people don't realize, when we go back and we study that market, it was manipulated by the manufacturer. And then market makers, market manipulators came in and they said, you know what, we can do something like this. Then you had the average soccer mom wanting to invest in Beanie Babies. You had, architects, lawyers that had no interest otherwise in that market. Because let's be honest, it was a ridiculous concept. It was a bean-filled child's toy that sold for like $6. So you had people coming into that market for all the wrong reasons. And there are mirror incidences of that as to what's happening with Pokemon, Magic, Yu-Gi-Oh, comic books, where you do have people that are seeing these asset classes rising exponentially. And they're like, you know what, I want a piece of that. I'm going to try to invest in it. So to answer your question, it's not going to go like Beanie Babies, where it's going to crash and everybody is going to lose interest in these just overnight almost. Now, to be fair, the Beanie Baby bubble did last almost 7 to 8 years. Most people don't realize that.
Yeah.
When we talk about Beanie Babies, if you were in that market and you were like 3 to 4 years in, you had people coming to you, no, this is going to be the next big thing. It's already been going strong for 3 to 4 years. That's why when I said in the beginning of this video, I look at markets in terms of decades, not months or years. I don't care what markets are doing today, tomorrow, next year. I'm worried about the long-term trend, which is what everybody needs to be concerned about if you're trying to argue that these are good investments long-term.
Yes.
Now, what I will tell you is, what my concern is, going back to your point, I think that the top 1 to 5% of the market is going to do okay. The problem is, at some point, those markets are going to plateau. Like, I'm sure that you're familiar with like Rudy with Alpha Investments, SM Pratt, all these other guys in this particular sphere that talk about these items. And this is one thing that concerns me. At some point, I think we're going to get to a period where an Alpha Edition Black Lotus, graded by PSA or BGS and very high grade, it's going to come up for bid and it's not going to sell past the previous high price. It's just going to level at that particular price point. And that's what's going to scare a lot of people. And some people are going to go, oh, that's just an incidence. That's just a quirk in the overall market. Eventually it'll rise in value. But a lot of other people are going to be like, whoa, it's not going up anymore. What's going on here? And this is what happens in traditional antique markets. This is what happens in other collecting categories if they fail to become established or sophisticated markets. And this is something that you got to realize, because in most markets, especially pop culture collectibles, there's catalysts that are dictating the value of these items over the years. Like, look at Star Wars. Everybody thought Star Wars is one of the most successful film franchises at all time. If I put my money in any type of Star Wars collectible, it's going to go to the moon. It's going to keep rising. Well, I can show you articles back in the 1990s, even before the prequels came out that George Lucas did, episode 1, episode 2, episode 3, where there was articles written by obviously uneducated investors in this space that said eventually the average 12-back Star Wars figure, that was the very first Star Wars figure that was available on store shelves back in late 1978 when the original Star Wars movie launched, there were people that were assuming those particular action figures were going to one day sell for $10,000 to $20,000. Just your average run-of-the-mill 12-back figure. Today, even with the advent of third-party grading in that space, thanks to Action Figure Authority, AFA, we can see, unless if you have like a vinyl cloth or a vinyl cape Jawa, or a, a double telescoping Luke Skywalker or Anakin or Darth Vader or Obi-Wan figure, you're not getting anywhere near $10,000 to $20,000 for a vintage Star Wars figure. This was the same mentality that speculators used when Kenner Toys, which then became part of Hasbro bought the rights to Kenner. Then when they released the Power of the Force 2, the orange back Star Wars figures back in the 1990s, and even the episode 1 figures, everyone's like, oh, I got to get them. They're going to be worth money like the early ones. Well, why did that not play out? Because number one, the market didn't work the way those speculators thought, first of all. And second of all, too many of them were hoarded.
Because they assumed that it would work out the exact same way. Yeah.
And that's what's happening right now in Pokemon. Like, oh my gosh, I got to get a factory sealed booster box of Battle Styles. I'm going to buy two. No, I'm going to buy a case. I'm going to keep them sealed. And you have everybody just hoarding this stuff. And it's like, dude, what are you doing? This is baseball cards of the 80s. This is comic books of the 90s. This is toys all over again. And they don't realize that when they go online and they encounter other people with this mentality that are telling them, oh, just stay the course, they're operating in that same mindset. It's not something that is sustainable long term.
Yes, I agree. And so one thing that I find pretty fascinating is that if you get the moment where that euphoria wanes, where people realize, hey, there's millions of people hoarding Hidden Fates, and Hidden Fates, while it's a great set and everything, if everyone has it, it's not really worth much. When that euphoria wanes, the articles from CNBC and all these places that like to cover it to get clicks will go from the Pokemon craze into the Pokemon crash. And so, because they aren't really looking into that 1%, they're looking at the overall market. When they see millions of people losing money on Pokemon, the types of articles that will be created will be very different. And I'm wondering what that will do to that top 1 or 5% of items. Because, if everyone is believing, well, the Pokemon market is crashing, that could have effect on people willing to suddenly drop, I don't know, $50,000 on a Charizard when they think everything is on fire, even though it's, the hidden fates boxes that are on fire. So how do you feel about that? Do you think that when, the 99% crashes down or becomes stagnant, do you think the 1% will also see some pretty bad times, let's say?
That has happened. And that is a major risk. These markets are not as stable as Wall Street, as financial markets, because they're so niche. Mm-hmm. The average person, and I get in discussions on this, especially with people in the comment section of my own YouTube channel. Yeah, they'll come to me with, you don't understand how popular this is. It's the biggest thing ever. And I have to explain, compared to Wall Street, compared to real estate investing, these markets are literally 1% the size. I can prove that to you. You can take any, even like I like coins and currency. That's my thing. Historical artifacts, created in the United States by the US Mint. That's what I tend to go after. And even that market, even for how large it is, that is one of the largest markets in the overall antiques and collectibles trade. If you look, it has a market cap of roughly $3 to $5 to $4 billion per year. That is roughly more than 2 times the size of comic books. And that's I want to say almost an established market. I wouldn't say sophisticated, but comic books, vintage comic books are starting to come in their own. Mm-hmm. Even that $4 billion, if you look at what's traded on a day in Wall Street or how many houses or pieces of real estate are sold, it's less than 1%. It means absolutely nothing. The average person that works a 9 to 5 has no benefit by diversifying into collectibles. I'm just going to say it's not a stable market for the long term. You can't compare it to an S&P 500 index fund. You can't compare it to a stock market. You can take the principles that'll make you successful investing in stocks, bonds, mutual funds, ETFs, and real estate and apply it to the collectibles trade. That's what's happening right now in reverse. You have all these people that are educated on Wall Street. They all have finance degrees. They're coming into these markets and they're convincing the Timmies, here, buy this. It's going to be worth a ton of money. Not realizing when that market goes south or after that person cashed out, that person's not going to care about the Timmies, Kimmies, and Poindexters anymore. Mm-hmm. They got their money. They did what they needed.
Do you feel, though, that, because this is something I see and I'm very scared of, let's say, there's people who try to use these proven methods, these proven ideas, and they try to force them into these markets where they don't belong. Like if you read something like, I prepared some books. We have a Bogle book right here. Something would be like, oh, dollar cost average into the S&P or the good old same old. There are people who currently say, oh yeah, the Pokemon market is so high, but you can dollar cost average into it. I'm like, it's not because you're using this concept that works in proper established assets that suddenly is going to work for these super speculative ones. So I was wondering, since you mentioned, using these certain terms or buy the dip or stuff like that, I feel like that's very dangerous in these markets because it doesn't make sense, because that assumes that in the long term, the market will still be up.
I agree with you. Let's look at Hummels. Mm-hmm. Hummels was a popular antique market that pretty much came into fruition after World War II. If you don't know what a Hummel is, you can easily Google it. It's basically a porcelain statue that came out of Germany after the war that became very popular among post-war Americans because they were exposed to it overseas when they went to fight. And it just became this massive market in the overall antiques and collectibles trade. Well, there were a lot of people, I'm going to start collecting these. These are going to be the next big thing. And to be fair, for a time, they did transition as an established market in the overall antiques and collectibles trade. The problem was people were trying to invest in them and they tried to apply dollar cost averaging to this market. Yeah. So when the market was going, when it was stable and starting to upward decline, they were doing pretty well, because if they were buying a piece, let's say it was $100, then they bought in another piece and maybe the market was up, they paid 120. Then there was a little bit of a dip and they paid 110. I'm just pulling these numbers. Yeah. They're not real. I'm just pulling them out of the air to prove my point. Mm-hmm. But if you look at the market as it was going up, people could look back and go, look at this. I bought in at the right time. If you analyze what I paid for this collection, I could sell it today for $10,000. Well, the problem was they didn't know when to sell.
Yes.
And eventually, as time went on, younger generations, after they had kids, their kids were like, well, I'm not going to collect Hummels. That's something that you guys like. What the hell am I going to do with Hummels? I don't want that.
Absolutely.
Less people in the marketplace buying, prices started to fall. Dollar cost averaging works best. If you are putting together, if you're a very wealthy individual and you're investing in real estate, you can use dollar cost averaging to work for you if you're buying rental properties. You can use dollar cost averaging if you're just an average investor and every month or every week you invest in an S&P 500 index fund, if you invest in a total stock market index fund, if you invest in any type of ETF that has a similar method where you're investing in equities, you can do dollar cost averaging. It does not work very well on speculative niche markets. So even if you come to me and you go, Sean, I want to build a position in XYZ stock, whatever stock it is, you have to understand there's market risk for investing in one asset class. So for instance, even if you're going to come to me and you're going to go, I'm going to put all my money in ExxonMobil, that's very risky. Look at where we are today with alternate energy uses. Why would you put all that money in ExxonMobil? Well, if you want, you can dollar cost average into ExxonMobil, but it's not a wise strategy for the long term or even the short term in that manner.
So to jump from your Hummel example just now, you mentioned how it went into the more established, or maybe not completely, but it got closer there. Do you feel like there is still a risk in these more established antiques, in the sense that these people that are currently super into them will one day pass away? And so some of these might also have similar risk, but not as badly as, for example, a Pokemon, like even the top percent. Because right now, like you said with the Star Wars example, Pokemon is all hot, but one day that generation will die off, and they will give it to their kids, but their kids didn't grow up on Pokemon, or it wasn't as exciting. Now, the thing is, there are items like that that are closer to established. For example, something like stamps is something that would worry me, in the sense that there's a generation of kids very soon that do not use stamps, and it's not going to be a thing like 200 years from now or something like that. Do you feel like there's pockets that still have that level of risk of a generation dies out and it takes that more established category down with it?
Correct. Absolutely. There's risks in everything from that standpoint. Even if you look at hardcore traditional antiques, that's why I tell people, go into markets where there's significant overlap. Like if you look at coins, if you want to go after and you want to collect gold coins, at the end of the day, you still have whatever ounce of gold is in that particular coin that has value. So if you want to go and you want to collect, like in the United States, we have something called St. Gaudian's $20 gold pieces. Okay. They were minted by the US Mint in the early 1900s all the way up to the 1920s and 1930s, though that's where it gets a little bit complicated because of FDR's rule that you couldn't own gold. They had to do some interesting things at that particular point during the Great Depression, and also which led into World War II. But what I will tell you, if you want to collect St. Gaudian's $20 gold pieces, at the end of the day, even if you're going after just ungraded, uncirculated examples, there's still almost an ounce of gold in those pieces. So it's both historic, and it also skirts the line where you're also investing in precious metals that way. So that's why I tell people, when they get into these markets, you have to look for something that is either extremely historic or also has some type of intrinsic value that future collectors or investors are going to want a piece of. And a lot of pop culture markets, unfortunately, don't fit that bill. That's why I said, if we go back to the 80s, we go back to the 1980s in America, if you're learning the antiques and collectibles trade, you know what the number one collectible is almost when we talk about pop culture? Western-based toy collectibles.
I've heard about that from you.
Items that were produced on the Lone Ranger, or what is it? Gosh, I can't even think of all of them. Gunsmoke, Bonanza, what is it? Sundance, Cassidy? No, Cassidy, I don't know. Cassidy and the Sundance Kid. I can't even remember them all. It's so frequent. Well, if you went back to the 80s, these pieces were selling for top of the market. So if you went to an auction house in the 1980s, if I took you back in a time machine, you'd be like, why did that person just pay that premium price for a Marx playset based on cowboys and Indians? Well, back then, that's what everybody grew up with. That's what they knew. So the baby boom generation at that particular time, they were very fond of those items because they were coming into their own. They were in their 30s and 40s, and that's what they grew up with in the 50s, 60s, and 70s.
So, sorry, you can continue.
Oh, it's okay. No, go ahead.
Okay, is there an age, in your opinion, where these assets, let's call them, where that generation will no longer go after them because they are getting too old for that item? Is there something that you see consistently happening there?
Yes. Usually when somebody gets into their 60s and 70s, that's when they're downsizing.
Nice.
One of the questions that I love answering in the comment section, and I get this a lot,
Mhm.
well, Sean, what happens to all these senior citizens when they have free time on their hands in their 60s and 70s? Don't you think they're going to get back into buying Atari games or Commodore games? And I just sit there and laugh, dude. Your life is going to change. I usually get asked this question, no offense to you, because I know you're in your 20s.
Mhm.
It's usually 20-year-olds that ask that question because a lot of them, not everybody, but a lot of them in their 20s, they look at me because I'm in my 40s. I'm 44. They look at me as an old man. They don't realize 20 years is going to go by like that.
Yes.
And when you hit your 40s, you're looking at life in a different perspective. You're not thinking, well, I only got 30 years left on this planet. I think I'm going to start collecting. It's usually, if you're already collecting something, it's because you're a collector. And at some point, you're just going to hit that natural progression where you go, you know what, it's time to downsize.
Yeah.
What we see in the trade is that most people get there in their 60s or 70s. Now, there are some exceptions to the rule where you have very successful people in their 70s thinking that they're going to live to be 110. God bless them if they do. And they're still going after some of these pieces. So that's why you will see, if we look at like Lionel trains, Lionel trains and collecting toy trains was very popular among baby boomers. Well, now as these people are getting older, that market is really, really hitting the skids. Well, there is certain toy trains, Lionel trains, that are still selling for a premium. Why is that? Because there's always that exception to the rule where there's this very wealthy guy that says, no, I am going to be buried with all this stuff. I am going to die with it. I don't care if it goes to zero. And he goes to the auction house and he says, that's a rare item. I'm going to bid $10,000 on it. And you'll see, well, a record price was paid for this particular item, but the rest of the market is crashing down. Nobody wants the average pieces. And you wonder, how did that happen? Well, they're all getting ready, I hate to say it, to go 6 feet under. Their kids don't want the crap. Their kids aren't interested in toy trains or Western collectibles. Let's be realistic.
That's actually a really big one. I often see in my comment section as well, people go, oh, I want this Blue Eyes White Dragon. Like the Blue Eyes White Dragon is the card in Yu-Gi-Oh! And people going like, oh, one day I'll give it to my kids. And I'm like, well, is your kid growing up on Yu-Gi-Oh? Because if not, it's kind of like a, why would you? There's a lot of things that I got from my grandparents that I'm like, well, can't really do much with it. The only exception would be watches, which I find fascinating for that reason. Now, one thing that we touched upon earlier for the Beanie Babies was that the speculative bubble, let's say, lasted 7 to 8 years. And what's interesting is it kind of faded or fizzled very close to the .com bubble. It was slightly after, as far as I'm aware, but it was relatively close. Do you feel like there was a correlation between Beanie Baby euphoria and the increased liquidity, let's say, from speculators because of the .com euphoria happening very closely to each other? Or do you feel like these were completely separate?
I will say that they were completely separate. What amazed me about the .com era, and I was there, I lived through it. One of the things that I thought was hilarious, I had people arguing with me back then that like a company like plants.com or pets.com, a company that really didn't have a sustainable business model other than, hey, much like everybody else, we sell plants or we sell pet food or whatever it is. Just because they would add .com at the end of their name, and they would have a space on the internet, people thought, oh my gosh, that company should be more valuable than Ford Motor Company or AT&T, or pick whatever prominent company is still around today that you could compare this to. And this kind of gets me on talking about cryptocurrency a lot. Recently I'm looking at Dogecoin. Dogecoin has a market cap that is worth more right now than Ford Motor Company. Does that seem sustainable to anybody out there, given the fact that it is an asset class that actually provides no intrinsic value? I mean, if you own a share of Ford Motor Company stock, at least you get a dividend check every, 3 months.
Yeah.
If you own Dogecoin, it serves no purpose. The average person doesn't need to invest in it. And this is why I'm very controversial. Like you said in the beginning, I'm a contrarian for this reason. This is why people don't like me, because they go, well, Sean, you don't understand. It's going to be the next big thing. And possibly it could be. I could be dead wrong. But I would not be putting my money into a concept like Dogecoin or even Bitcoin at this point in time. I would go after a company that is sustainable, like Ford Motor Company or AT&T, probably a bad example right now because they just cut their dividend, or any, you know what I mean, that pays a dividend and has a track record. That's what I look for. And it's the same way I analyze markets in the antiques and collectibles trade. So going back to what happened during the dot-com era, there was a lot of speculation in that market, much like Beanie Babies. Do I think that there was some overlap? Yeah, I think that there were a lot of speculators that are operating in both. So I do think there was overlap, but they were two distinct paradigms. They were not directly related.
Right. Because right now, what I'm seeing, and again, very similar with cryptocurrency, there was this juice company, just a regular mom and pop store that put some crypto in their name and then went public with a SPAC. And suddenly it's worth millions when it's just literally a little juice store because apparently they do something with crypto. So it's a very similar story. But the reason I'm bringing it up right now is because I believe, and I might be dead wrong here, there is a correlation between pop culture, collectibles, and cryptocurrency.
Oh,
and
definitely.
The reason is I get a lot of people offering me like, hey, I'll give you $10,000 for that card, but in Ethereum. And I'm like, okay, so there's a lot of, well, first of all, they're trying to dodge taxes in some way, probably. They're trying to cash out their position, get the collectible that way. I understand that. But that also shows that a lot of these guys' liquidity is entirely tied up in crypto. So how do you feel about the potential for a correlation in crypto and the pop culture collectibles right now?
I think there's definitely a correlation there. There's a lot of people that made a lot of money in cryptocurrency or Magic the Gathering, vice versa, and other pop culture collectibles and put it all in one or the other.
Yeah.
I will tell you, you got to look at how we got here. And I think this is the question that nobody wants to answer. And I watch a lot of YouTube channels and nobody really wants to talk about this. And it comes back to what happened, especially in the United States, 2008, 2009, the financial crisis. We had that massive event. The government stepped in. And again, I'm not getting political. I don't care if you live in the US and you're watching this video. Again, I don't care if you're a Republican, Democrat, Independent. In my opinion, they're all implicated in this. Going to be honest, there's pretty much nobody that serves a political party that is not implicated in what I'm about to say. Well, if you look how our government handled the financial crisis, we bailed out all the banks. We didn't jail any of the bankers that were responsible for bringing down the system. We did everything wrong, in my opinion. Now, some people may disagree with that because, to be fair, I will entertain this point of view. We did have to bail out the banks, obviously. Otherwise, liquidity would have dried up in our economic system, which would have spread to the rest of the world. It would have been far more massive than what it was.
Yeah.
So I do agree with that. But if you look, your average person that came out of that, they no longer trust Wall Street. They don't trust bankers. They don't trust the government. That's why in the US right now, we're going through this massive political divide where if you follow politics in the US, it's either Trump or no Trump, or I want this guy or I want Bernie Sanders. It's because nobody trusts the basic regular politicians who have been in politics for their whole lives. Same thing with bankers. So that's where I get when people come to me and they go, Sean, you really preach traditional assets. I'm a little bit hesitant on that. And really what they're saying is, I don't understand how traditional assets work. They're not going to ask that. They're not going to word it in that way, but I can pick up on it through how they're wording the question. So where I will say is this all goes back to 2008, 2009. Those people lost a lot of money, or they know somebody who lost a lot of money. Now, from my perspective, if you had a S&P 500 index fund or a total stock market index fund like I did back in 2008, 2009, as long as you didn't sell, you were fine.
Yeah.
Now, if you were investing in XYZ risky stock, and obviously with the shakeup, risky stock went from $100 a share all the way down to $5 a share, then bankrupt, Yeah, you lost money. But for the most part, if you got on the roller coaster ride that is known as the stock market and you didn't jump off midway through the ride, you didn't lose any money. As a matter of fact, if you kept going back to dollar cost averaging during the financial crisis, if you kept contributing to an asset like a 500 index fund or a total stock market index fund, you're sitting pretty right now because you got to buy it at a very below average amount during that time. But I understand why people were calling for a cryptocurrency or some type of currency to emerge that is deregulated, definanced, meaning it's not related to a central bank.
Yeah.
So I get how cryptocurrency became a thing. I also get why certain people looking at the value of their 401k statement or their IRA, whatever it is, during the financial crisis said, you know what? Wow, look at how much I'm losing. Collectibles could be a valuable alternate class. And that's really how I think we got here. So I think that there is a merging of ideas, especially now with the advent of YouTube, the internet, collecting forums. You know, anybody out there, even if you have a very weird point of view or you're a conspiracy theorist, you can go on the internet and you can find anybody that has that same point of view and you can converse with them. You could set up your own forums, your meets, whatever you want to do. So it's really taking the concept of investing in new ways. And I don't dispute that. I'm not against that. What I am against is the speculator mindset where, well, Sean, I don't understand how that works, or that burnt a lot of people back in 2008, 2009. I'm not going to touch it. And that's a major mistake that I see. There's too many people that are going headstrong into cryptocurrency, collectibles, gold, silver, and they have no exposure to stocks. They have no exposure to bonds. They have no exposure to real estate. Hell, I have people that reach out to me. I live in a one-bedroom apartment and they're spending $5,000 a month on Pokemon cards. What are you doing?
I know. It's very dangerous. But I do I mostly agree with everything you said, by the way, just now, but I want to play devil's advocate for a few seconds because I do think it's interesting. You mentioned the S&P 500 index fund. I myself used to be putting, all of my equity money basically in that. However, I moved to global at one point where I'm now international plus US essentially. Now, one thing is right now, if you were to dollar cost average into an S&P 500 index fund, while in 40 years you would probably be fine, there's quite some people who are afraid of it because if you look at its PE ratio or the Buffett indicator, as some people like to use instead, because it involves a few more ratios. Let's keep it very easy. It has not been this overpriced, let's say, in decades. And so there are people right now who are, let's say, afraid of either an imminent crash. And I know you can't time the market, time in the market is more important. That's a typical thing people will say. Then again, if you bought into stocks in 1929 or 99 or 08 or 07, sorry, you're still not feeling that great. So do you feel like the advice, let's say, to put into the S&P right now might still not be ideal purely because of, well, it could be very overpriced, especially American equities as a whole?
Oh, it is overpriced. I'll be very honest with that. I'll be the first to tell you that. It is overpriced. But you got to look at how we got here. Mm-hmm. We pretty much had, at least in the United States, again, I can't speak for other countries, so I do apologize. But in the United States, you had pretty much companies that at one point offered all their employees a pension plan. Mm-hmm. Or meaning if you went to work for this company, if you stayed with them 20, 40 years, you were going to get out of the company profits, future company profits, they were going to cut you a check every month for you were alive. That was part of their agreement with you working there. Well, what happened? We had the Reagan tax cut. We had deregulation come in, and all of a sudden companies said, you know what, we can outsource overseas. We don't need to pay these people a pension. So who did that benefit? Wall Street. All the Wall Street bankers, all the Wall Street investors, the guys that sit and run the hedge funds, they run all these big banks. They said, you know what? Come here, little corporation here. We can cut you a deal. We can have you set up something called a 401k plan where all the money is invested in Wall Street, and we'll take fees out of that. And as long as your company, your employees and yourself put a matching contribution in there, all that money will be paid back to them 20, 30, 40 years later. And what's great, if you do decide to outsource, or if little Timmy doesn't make it 10, 20 years at that company, you decide he's not a good fit, as long as he's vested in that plan, he could take that money and he can roll it over into whatever company he wants to go through, Vanguard, T. Rowe Price, Charles Schwab, whatever investment company. So what happened was, what I'm getting at here, make a long story short, is pretty much Wall Street came in and said every American needs to invest in stocks, bonds, mutual funds, or financial assets. Mm-hmm. And that caused an explosion of wealth to come into Wall Street. So that's why we're sitting now at pretty much 20, 30, 40 years later when this occurred, where all these asset prices, when we look at equities and stocks, the PE ratio is out of whack. What I will tell you, though, is it shows, number one, no signs of stopping. And if you go back and you look at the PE ratios of stocks in the 1980s, in the 1990s, even before and after the dot-com bust, mm-hmm. you'll see they were exponentially just as high. So what I'm stating is, in my opinion, what caused this was the retirement rush to go with Wall Street for all these assets and do away with traditional pension plans. Even if you look, when you look at Social Security in the United States, mm-hmm. Social Security, I'm going to say it, yeah, it's needed. Don't get me wrong. I think they should strengthen it, my personal opinion. But it's a joke when you look at what somebody gets to try to live on every month. I mean, in some cases, there's people on Social Security in America that are retired. The government sends them a check for roughly $800 a month. You cannot live almost anywhere in the industrialized world for $800 a month. So it is something that you kind of have to weigh both ends. So I look at it a little different than most people, but that's only because I went to school for finance and I had that drilled into my head. So to be fair to you, if you want to play devil's advocate with this, it may be, okay, well, Sean's educated in finance. That's why he's coming at it from this perspective.
So there are some people who would say that even Social Security will probably not be solvent or as solvent, let's say, in the future. Maybe partially because that money is also in the stock market, usually working in some type of mutual fund. In this Bogle book also, he mentions how I don't know the Social Security climate in the US, by the way. I'm from Europe, so it's not something I'm super deep into. But as far as I'm aware, Social Security solvency still depends on your stock market. That's correct, right?
It's not linked directly to the stock market. Mm-hmm. There have been times where they wanted to try to privatize Social Security, which mm-hmm. would mean, again, more fees and more wins for Wall Street and the bankers. If that ever happens, then stocks are going to go up even more. Right now, Social Security is not invested in the stock market. It's pretty much a contract between the government where the government has a fund set up to pay Social Security expenditures. The problem is the amount of money coming into that fund versus what's outpouring from that fund. Mm-hmm. The outpouring expenditures are greater than what's coming in. So at some point, yes, you are correct. If something doesn't change with Social Security, it will be insolvent in the United States, but it is not directly correlated to the stock market as of yet.
So you mentioned how at one point you pushed, let's say, the 401ks with the companies and so forth, that bloated your stock market, let's say. But beyond that, you also had 2008, you had your QE happening and never really deflating, let's say. There was no point where your government chose to stop buying all of these assets in order to basically keep their price high, let's say. So they also at some points have tried to increase interest rates the past few years, and or even just signaled that they might try. And every single time you see the S&P just take a dive, and then they suddenly go, no, we won't. Okay. And then suddenly the S&P is doing fine again. Do you feel like because of all the expenditures that they have been making, they can't keep on doing this, that there is still, however, a risk because of that? Because, and again, I'm mostly equities, so it's not like I am telling people to not go into it, but I do feel the risk is there, because similarly, even in real estate, right now, people are saying, there's these bubbles in crypto and in collectibles, and I agree, but when real estate goes up 20, 30% in 1 year, I don't know if I'm feeling that great about putting my money there, similarly in S&P and so forth. So is there a place even that isn't overpriced currently?
Bonds, but they're boring as all hell. Nobody wants to invest in bonds anymore. What's the rate on the treasury yield right now from the US government? It's gotta be, gosh, I haven't even looked at it in years. I think it's under 1%, honestly. It is that low. It's horrible, but it's safe. I mean, if that's what you want to do, you're not going to keep up with inflation investing in bonds.
Yeah, exactly.
That's the main problem. It's where do you put your money? You have to assume some risk. And that's why I liked, like in the 1990s, I remember, you know what a certificate of deposit is, right? At a bank.
What?
A certificate of deposit, a CD.
Oh, yeah.
Okay. You used to be able to get like 24 months, 36 months, almost 5%. That's unheard of today. That's like 0.5%. If you're lucky, you get 1% today.
Yeah, but interest rates were higher, right?
Correct.
Yeah.
So at some point, I think we need to get out of this. We can't raise interest rates because it's going to affect the overall growth of the economy. And what's sad in the United States, our economy is linked directly with politics. So you have politicians that come in and they go, well, I'm not going to be the one that tells the Fed to raise rates, because if they raise rates, I'm not going to get reelected, or my party is going to suffer significant losses in the next election. And it doesn't matter, again, Democrat, Republican, I don't care. It's just that's the thinking that goes into these decisions. And sad to say, we make a lot of our decisions based on stability of the status quo. I hate to say it. So you're 100% correct. Where do you put your money then? And that is also what's driving the decision of people to invest in collectibles. There are people that have come to me and said, yeah, Sean, I'm versed in stocks, bonds, mutual funds. I don't want to put all my money in that asset class. And I said, that's fine. You don't have to. But just understand, in some cases, I tell these people, you'd be better off in gold, dude. If you don't want to diversify, you're worried about all these risks, at least with gold, I'm here to tell you, gold is not a niche market where if somebody loses interest in like Pokemon, Yu-Gi-Oh, Magic the Gathering, they're going to dump the collectible and it's going to drop in value. At least with gold, it goes through peaks and valleys, but it always has some value on the market. It may not be at all-time highs. It may not be a good inflation hedge overall over the long term. But at the end of the day, at least you can take it and liquidate it to almost anybody. I mean, you can go to a pawnbroker, whatever, and at least sell it, where you don't have to worry, well, I'm sorry, Mr. Smith, nobody's collecting Pokemon cards in the year 2053. You know what I mean? To use as an example, you're not investing in pop culture at that point. Now, do I like gold as an investment? No, I'm going to tell you, it's horrible in my opinion. But there are people, if they want to invest in something safe, if they want to take $10,000 and rather than put it in a savings account, you're probably better off in gold right now, given interest rates.
So that's an interesting one, because I do feel that because of all these fears that people have, you know, everyone says, oh, money printer, go burr, is something people sometimes like to say. That has made these gold bugs super loud. So you have a Peter Schiff or a Robert Kiyosaki and so forth going like, well, there's going to be inflation, so you put all your money into gold. Well, that has made the multiples that you're paying on gold quite high, I would say. So right now, sure, you could say it's a safe haven, it's an inflation hedge, and you alluded to not agreeing with the inflation hedge part. So, but like it is entirely possible that you are still overpaying for the amount of gold you're getting. You know, like if you want to use it in science in some way, the amount they will pay you to use it is much, much lower than the amount you put in to get it. So, you know, while equities could go down 50%, gold could too, I want to say, if you buy it right now.
But gold has one thing going for it that cryptocurrency does not. And this is something that people are not looking at. Why is the price of gold being suppressed? If you think it's being suppressed, a lot of people come to me, Sean, they're suppressing the price of gold. What's really happening in the gold market right now is a lot of people, instead of going after gold, they're going after cryptocurrency. So money that would have went into the gold market is now going in cryptocurrency instead. So that's what's also helping a pullback in prices of gold. If we didn't have cryptocurrency right now, in my assessment, and there's a lot of other intelligent people, I was watching one by, who was it, Bill Ackerman, one of the top billionaires.
Yeah.
Hedge fund. I was watching a video where he made a statement, and again, don't quote me on this because it could be a couple of years old, where he said, if gold was not being suppressed, the price of gold right now would be between $5,000 to $10,000 an ounce. And when you look at why it's being suppressed, is a lot of people, rather than go after gold, well, crypto's the new gold. Let's all invest in cryptocurrency instead. Not realizing, in my assessment, At least gold does have industrial uses. At least gold can be minted in the jewelry, coins. When you look at cryptocurrency, the average person does not need to own cryptocurrency. It is a bunch of people, speculators, coming into that market saying, you know what? More people are going to buy this particular asset. That's why it's going to go higher. But when you look at the basics of it, does anybody need to own crypto? Are you really going to buy something? Are you going to go to Walmart or whatever store and go, you know what? I want to buy my groceries with cryptocurrency. They would look at you like, okay, that's even if they accept it.
Yeah, and the funny thing is, I don't know how deep you are into crypto, but I've been playing around with it for quite a while. If you were to use Ethereum right now to buy something, there's what's known as gas fees. So essentially, you need to pay an amount of Ethereum just to do something with it. And so if you bought a like $2 hamburger in Ethereum, you would have a $200 hamburger because the Ethereum gas fee is that high. So as a currency, it's really like it's kind of a joke. However, I will say, playing devil's advocate, because I do believe in the tech behind it, just not the speculation going on in the space. There are a lot of financial services and bank services and so forth that will probably be built on blockchain technology decades from now, in the sense that the way smart contracts work, the whole DeFi space is interesting. The thing that gets me is people think that that utility will automatically mean that the currencies are going to be worth even more. And while that's possible, it's not necessarily the case. Like, it is entirely possible that we have massive technology built on blockchain while Bitcoin is stagnant. And that is, you know, those aren't inherently fighting concepts, let's say. So I do find it, I want to give credit to the tech. I'm just not much of a speculator in it, if that makes sense.
Oh, I agree with you 100%. And I can always see when I downplay crypto on my channel, there's always a crypto bug that'll come in the comment section and feel a need to defend it. And you got to analyze. I even tell people, why do you think that's happening? Because he has a position in that currency or that particular crypto coin, and he needs to protect it. Because if people sit there and go, oh my gosh, they may sell after seeing a video of mine, which I don't know why you would sell crypto after watching some guy with 6,000 subscribers on YouTube give you his point of view. But if you do that, if you do engage in that, you have to understand there are reasons why people are attacking the particular point of view or the person who's stating that contrarian viewpoint. And that happens a lot. Same thing, like whenever I talk about great at video games, I don't know if you follow this market. Whenever I talk about great at video games and I talk about WADA games in particular, how speculation came into this market, how market manipulators got involved, there's people that always attack me because they don't want to take a step back and go, okay, look at the organic demand of this market. Is it really at a point where people are going to pay X hundred thousands of dollars for a factory seal video game released in 1985? Is somebody born in the year 2021 going to grow up and want to pay X hundreds of thousands of dollars for a video game that was released in 1995 before they were even born? The answer, most likely, I can answer it for you because I've been in the trade so long, no. And that spells a very bad formula for the people that are thinking, I'm going to buy this game, I'm going to put it on my mantle, and 20, 30, 40 years ago, we're going to sell it for, 1.4 million, 2 million, 3 million. Markets don't work that way.
Yep. I do feel, and it's interesting, the emotional response that some people have towards things they've put money in, it's mostly because people don't want to feel stupid, which I think is like a very big one. Like, I've one of the books that I actually got because of you. So you should get an affiliate link, right? This one. So I read a lot, and this was one I saw from your channel, where it mentions that when you are trying to consult, let's say, a high net worth individual for their investment in collectibles, it's usually they want to buy something and not feel stupid about it, which I think is very fascinating. Like, it's not so much that they lose money, but more so that other people will know that they made a dumb decision. That does a lot. And so I feel with crypto, that's the same way. That emotional response of I bought Bitcoin at 60,000 and now it's down to, I don't know, is it 33 or something like that? And that fear of, oh no, I'm going to look stupid is very powerful. And I feel like that's where it comes from, but maybe I'm way off.
No, you're absolutely correct. That and confirmation bias. That's why when I launched my YouTube channel, I knew I was never, it would be monumentous for me to get to 100,000 subscribers.
Mm-hmm.
And I appreciate YouTubers like you, other people like Pat the NES Punk. There's other people out there that really propped up my channel and said, no, this dude's on to something.
Mm-hmm.
He knows something here about these markets. The problem is the average person out there, when you expose them to an alternate viewpoint, even if it's correct, due to confirmation bias, they don't want to hear it. They just want to go, well, I can just ignore that guy and I can go to these other 9 channels that tell me what I want to hear.
Yeah, exactly.
It happens in every market where money is involved, where any type of financial asset is sold or bought, anything.
Yeah, I also think it's a positivity bias. And I've noticed this with my channel. Like whenever I talk about, let's take the blue eyes, and I'm saying, oh, this is interesting, I like this card because of this and that, people are like, oh yeah, thumbs up, thumbs up. But the second I dare to say like, oh, Pokemon or Yu-Gi-Oh, these things currently look in a bubble, like you get all the dislikes because it's just not sexy. I read very often that people say, why is this guy always nagging? And I'm like, I'm not nagging. I'm just very afraid for your financial stability. So I think that's a big part of it. Like if you were just constantly positive, then people are super hyped, but you're also misleading them.
Correct. I talk about Harry Rinker on my channel.
Mm-hmm.
Now, me and Harry Rinker have some things in common because we both came from Pennsylvania. I get his upbringing. And what's interesting is, though, this is what a lot of people don't know. And I'm going to reveal this on this particular video. So you get first at this. I never did a video on this.
Okay.
People often ask me why I like Harry Rinker so much. When I was growing up learning the trade, I actually set out to prove Harry Rinker wrong. Oh. I was one of these people in my teenage years that said, no, these markets, they're on fire. This is the way it's going to be. This is going to be the new thing. And I had mentors that would just listen to me talk and they wouldn't shut me down. They would say, okay, then we're going to show you the trade. You try to prove Harry Rinker wrong and we're going to see where you get to. And literally it took less than 5 years for me to realize, okay, Harry Rinker's 100% correct. These markets do not work the way that I want them to. And it's so sad because every time I mention Harry Rinker on my channel, I either get, oh, okay, cool. Thanks for turning me on to another person where I can get a different perspective. I appreciate that. But most likely I get, well, he's an old guy getting ready to retire. He doesn't know what he's talking about. Not realizing that he got to where he is because he had decades of experience in the trade, analyzing these markets, watching Beanie Babies become a thing, watching Hummels become a thing, watching comic books become a thing, watching coins become a thing. Basically, you get a pulse of the market over the long term after you see everything revolving through. And that's what a lot of younger collectors need to realize. So when I bring up Harry Rinker, it's not because necessarily I always agreed with him or wanted to agree with him. It's because I set out to prove him wrong, and even I couldn't. It did not work.
Yeah, everyone thinks this time it's different.
Yes.
So that's a pretty big. I notice the same with Warren Buffett. There's people sometimes I see in the comments where they go, well, he hasn't beaten the S&P in so long. He doesn't know what he's talking about anymore. He didn't get into crypto because he's just not smart enough. I'm like, really? There's so many arguments as to why that's wrong. But like, people will always think this time it's different.
Ask him, where's your billions? That Warren Buffett's an idiot. Come on.
Yeah, exactly. It's also just, I mean, once you have that many assets under management, it's just impossible to do anything. You get sluggish. There's nothing you can really do about that. So yeah, I think we have mostly covered everything. So was there anything that you still want to tell people? Anything you want to shout out? Thank you so much again for coming on the channel.
Anytime. I'm happy to help. I like sharing my knowledge. I like interacting with other YouTubers, even if they have a different perspective than me.
Blue eyes to the moon.
You don't always have to agree with me. I will say that. I could be wrong on certain things, but overall, the general gist and the trend of how to invest in these markets is not what most people think. And that's why I try to share my knowledge. When you look at the antiques and collectibles trade, just from an investment standpoint, a lot of people come into this market and they don't realize it's just as sophisticated as Wall Street. You're just dealing with a different set of numbers, a different set of criteria, a different set of items, if you will. But you can break down, like when we look at a stock, you can break down the fundamentals of a stock. It's very hard to do that with a collectible. So that's why you have to understand it's more speculative in nature. And what I will tell anybody who's listening, just know if you're going to get into these markets, either short term or long term, You have to start learning the fundamentals. Be careful who you listen to. That's always my best advice, because I'm sure that you encounter this. I have people that will go on online collecting forums. Don't listen to Reserved Investments. Don't listen to Reserve. Don't watch any of his videos. He doesn't know what he's talking about. Are you aware? I'm exposed on a daily basis, and I'm sure you are, to tons of hype-driven channels out there. And you know what? I don't tell people not to watch them. I want them to succeed. They're putting out a different perspective. If somebody wants to follow that advice, it's not my responsibility. Let them. But overall, that's the difference between me and a lot of other people. I'm not telling anyone, well, don't listen to that particular YouTuber, don't listen to that person, or that person's wrong. I want them to have exposure to that. I also, though, want them to have critical thought where they go, okay, I listen to this guy who's telling me to buy these 5 Marvel comic books or Marvel Universe trading cards. Let me see what Sean is putting out in his channel, and let me see if I can get something, another perspective out of that. That's where I think a lot of these discussions materialize from. It's a combining of, okay, is Sean too bullish? Is Sean too bearish? Is this other guy, is he a market manipulator? Or is he too bullish? How are we analyzing this? And I always say the answer is somewhere in the middle. I don't claim to have all the answers. I just teach the basics so that if you apply critical thought to a lot of the things that I present in my channel, you will become a better collector, speculator, or investor, whatever you decide to do. And that's my goal. So that's how I want to end this with you, because I think that's a good point.
Yeah, absolutely. Everyone should go check out the Reserved Investments channel, in my opinion. I enjoyed it all. It's also, I watch it because there's collecting categories there that I don't actually care about. Like when I collect stuff, it's Yu-Gi-Oh! I have a humble watch collection, mostly from my grandpa and a little bit of myself. I have always collected like weird little things, but when we get into like proper expensive quote unquote items, those are the two. And I like to stay up to date with these other ones because there's always things you can learn. Like if you make a video about vintage wine, I will still watch it because who knows, maybe that knowledge will be useful. And so I think people should check out your channel, not just for the contrarian viewpoints, which I think are the most crucial part, but also because if you are aware of what happened to Beanie Babies or Western collectibles and so forth, you can be more educated in all the markets, not just those specific ones. So yeah, if there's anything you still want to shout out where people can check you out, I know you did it at the beginning, but maybe it's good to also do it at the end. Feel free to do that.
Sure. Again, my name is Sean. I am with Reserved Investments. You can check me out on YouTube. You can email me at reservedinvestments@gmail.com. I do consulting for anybody out there that requires more additional help on how these markets work. I do any type of consulting calls where you can ask me questions. Just email me. I also write for Antiques and Auction News, and my articles appear on a bi-weekly basis in that publication. Thanks for having me.
Thank you so much for being on. I will see you soon. Ciao.